Hello again. Uh, the subscriber base has been really increasing, up over 200 subscribers now, so I guess I need to make a video once in a while. Um, I've been really interested in sector rotations. Today is January 21st, 2022, and there's some volatility in the markets and some talk that we're going to go into a big sector rotation from tech into value type stocks. So, and certainly looking at XLE energy for the last month or so, it's been on a tear. So, if you can figure out these sector rotations before they happen or as they're starting to happen, you could get an edge on the market for sure, and kind of in a fundamental way. So here I've computed a best bet line to the stock price using 20 points in the past. So I plot the slope of that line. So that basically is just a smooth percent daily change in the stock price over the last 20 days. So I plotted some of the spider sector ETFs against SPY, gold, and US Treasuries or TLT. So you notice during some periods, some sectors go up while others go down. So I've highlighted a couple periods where we probably had an inflation scare. So during those times, energy and financials are up, while consumer discretionary and technology are down. So when those inflation fears subside, then the opposite happens. So I've tried using past price action to predict future sector divergences, but I haven't been successful doing that. One thing that does seem useful is volume, and this kind of makes sense. During a sector rotation, the sectors that are going to move one way or another should see a change in the typical volume. But I think what we're really after is changes in relative volume, and by relative I mean relative to a broad index of all the sectors, e.g. the SPY. So here I plot XLB, which is the basic materials sector ETF. Versus the SPY. This is the volume. So the green arrow points to a period of low relative volume, where the on a percentage basis, XLB's volume is low relative to SPY. And other times, XLB has a high volume relative to the SPY. So the question now remains, what does the stock price of XLB do relative to SPY during times of low relative volume or high relative volume? Like, can we predict underperformance or overperformance of the sector using this relative volume? So here's a strange plot, which I'll explain in some detail, so be patient. I'm plotting the relative volume against relative return. So first, what is relative volume? That's just XLB's daily volume divided by SPY's daily volume. And I compute that in a 5-day average of past values. So next, what is relative return? So for each day in the sample period, here 1 year, I computed the forward daily return of the SPY and of XLB. So recall that we're trying to use past trends in volume to predict future returns in stock price. The relative return of XLB is simply the percent daily return of XLB minus the daily return of SPY. So for example, if XLB was up 1% on the day, and SPY was up 0.7%, then the relative return is 1% minus 0.7%, or 0.3%. So the horizontal dotted line shows that if the relative return is 0, then it means that XLB is moving at parity with SPY. Okay, so now what do the dots mean? So this chart is basically a two-dimensional histogram. So we have about 260 trading days in the sample set. So let's consider the red dot first. So on 70 of those 260 trading days, XLB's relative volume was between 4 and 8% of SPY. So in those 70 days, the relative return was positive 0.05%. So in other words, you have a 0.05% per day edge being long SPY versus XLB versus SPY in those 70 days. It doesn't seem like much, but over 70 days, that provides a 3.5% edge over the SPY. So what can we say about the other dots? So the size of the dot is proportional to the number of days that XLB was in a given volume range. So the largest dot is this yellow dot that corresponds to the 137 days where the relative volume of XLB was 8 to 12% of SPY. So in those 137 days, XLB's average return relative to SPY was a negative 0.03%. So again, it's small on a daily basis, but over 137 days, it means that you would have given up 4.1% of your returns by being long XLB versus SPY. So continuing to the green dot, which corresponds to the 48 days when XLB's volume was 12 to 16% of SPY. So in those 48 days, XLB returned an average of 0.07% less than SPY. So that means if you were long XLB, you would get 3.4% less return over those 48 days than being long SPY. So finally, the orange dot corresponds to the 4 days when XLB's volume was 16 to 20% of SPY, so very high. On those 4 days, XLB had a positive return. However, 4 days out of 260 total is not statistically significant in my opinion, so I would ignore that data point. So this graph plots the relative volume on a daily basis, and I break out the relative volume, the points are color-coded to the volume class. So the key observation here is that the relative volume tends to stay in one class or another for some extended period of time. So this lends credence to the idea that relative volume may be providing kind of a viable medium-term sector rotation attribute. So how would we trade it? The red points corresponding to times of low relative volume was when we had an edge over SPY. So that's a good time to be long XLB. So So now let's back test the results of being long when the relative volume is in one class or another. So I'm going to combine the first two classes, even though the yellow class kind of had a slightly negative expectancy. So when you combine the first two volume classes, which is 4 to 12% of volume, XLB volume relative to SPY, you capture 80% of the days out of those 260 days. So here's a cumulative return by volume class. So the yellow curve shows when the XLB volume is between 4 and 12% of the SPY. So that's 80% of the time. The red curve is when the XLB volume is higher, between 12 and 16% of SPY. So also I plot the cumulative return of XLB itself in green and of SPY in orange. So the conclusion here is that by cherry picking the best times to be long XLB, we're able to match or slightly beat the SPY while only being in the market 80% of the time. So presumably your cash would be allocated more productively on those 20% of the days when you're not long SPY, or not long XLB, being some other sector ETF. So we can obviously repeat this calculation for other sector ETFs. So for example, here's XLK, the technology sector ETF. You can see here that it has the opposite trend as XLB. So when the relative volume is high, the relative return is positive on average, and vice versa. So I like this strategy because it uses a very fundamental indicator, volume. And the periods when you're in and out of the market appear to be fairly long and contiguous. You don't want to be going in and out of the market daily. And for a sector rotation, you're kind of looking for medium-term trends. So I haven't started trading this yet, but I'm going to start putting it into my back testing infrastructure. And yeah, I would love to trade it. It's such a pretty simple strategy, and it does. I've been fascinated with sector rotations. I feel like if you can call sector rotations, you can be a fairly conservative investor, and yet you can absolutely beat the market if you kind of know where the momentum is. So anyway, let me know what you think about this. Kind of a work in progress, but would love to hear your feedback. See ya.